Welcome to Talk Tickers, where today we're digging into national CineMedia. They just dropped their Q2 earnings, and well, the market did not like what it saw. So we're going to break it all down, what happened, and more importantly, what's their game plan to fix it. All right, let's just rip the Band-Aid off. What was the immediate verdict from the market? A nearly 5% drop in the stock the very next day. Ouch. That's not just a small dip. That's Wall Street sending a pretty clear message that they were not impressed. So that brings us to the big question, right? What exactly spooked investors so much? A drop like that means something specific in the report really stood out. So let's dive in and figure out what it was. Okay, to get to the bottom of this, we've got to start where everyone else did, the headline numbers. Let's take a look at the data that drove that negative reaction. And here's where it gets interesting. It's kind of a mixed bag, really. If you look at earnings per share, they actually hit the nail on the head, right in line with what analysts expected. But, and this is a big but, the revenue was a different story entirely. $51.8 million. That's a miss against the consensus, and it's down over 5% from the same time last year. And that right there is the red flag the market latched onto. So, okay, we've identified the problem, the revenue miss, but why did they miss? Well, management didn't shy away from it on the earnings call. They pointed to basically a perfect storm of two big problems. It's like they were getting hit from both sides, you know? On one side, you've got these big economic headwinds. Think tariff uncertainty. It made major advertisers, especially in government and auto, get really cautious and tighten their wallets. Then, on the other side, you have this weird bit of bad luck. The box office actually had some surprise hits, but they came during a time that's usually slow for ad buys. So even with more people in seats, NCMI just couldn't cash in on it like they normally would. Now, this pain wasn't spread out evenly, not at all. The big national ad clients, they pretty much held steady, just a tiny dip. But the local and regional ads, man, that segment just fell off a cliff. We're talking a drop of over 30%. It's classic, really. When the economy gets shaky, it's those smaller, local businesses that slam the brakes on spending first. And that's exactly what we see playing out here. All right, so that's the bad news. A tough quarter, for sure. But what's the plan? How does the company fight back? Well, management laid out a pretty clear strategic pivot they believe will turn the ship around. And here's their four-pronged attack. First, they're going all in on modernizing their tech. Think programmatic and self-serve ad platforms. Second, they're rolling out a new AI-powered data tool. Third, they know they need to fix that local ad problem, so they're rebuilding their sales team from the ground up. And fourth, and this is the one investors always love to hear, they're focused on returning value through dividends and buybacks. And that push into programmatic, it's not just talk. They're already seeing some really promising signs. Get this, advertiser volume is up more than 50% quarter over quarter. That's huge. But what's even more exciting, I think, is that almost 70% of those advertisers are totally new to NCM. They're not just shifting budgets around, they're actually bringing new clients into the fold. So that AI tool I mentioned, it's called Bullseye, and it's a real potential game changer. Basically, instead of just saying, I want my ad in this movie theater, advertisers can now use AI to say, I want my ad to reach this specific type of person who lives in this neighborhood. It's all about making cinema ads super targeted and, crucially, measurable. And look, this isn't just some hypothetical tech they're dreaming up. It's already working. The CEO, Tom Lazinski, shared this great example on the call. A big national telecom company used Bullseye to run hundreds of really specific local ads. And the results? They saw double-digit increases in people literally walking into their stores. It worked so well that the client re-upped their contract on the spot. I mean, you can't ask for a better proof point than that. Okay, so we've seen the rough Q2 and we've seen the comeback plan. That brings us to the million-dollar question. What happens next? What should we expect for Q3, and what's our official take on the stock? And honestly, this is where the plot thickens. After that disappointing Q2, you might expect them to be cautious, right? Wrong. Their guidance for Q3 is actually pretty bullish. They're calling for a big jump in revenue to somewhere between 62 and 67 million. If they hit the middle of that range, that's actual year-over-year growth. And they're expecting to do that even with a summer movie slate that's not as strong as last year's. That's confidence. So, if you're watching the stock, here's what you need to put on your calendar for the rest of the year. First up, the Q3 earnings report. That's the first test. Did they deliver on that optimistic guidance?
Then, all eyes will be on the holiday movie season in Q4. A strong box office would be a huge tailwind. And finally, that big, ambitious goal to triple their programmatic business by year end. We'll be watching very closely to see if they can pull that off.
All right, so after digging through all of this, what's our call? We're slapping a market perform rating on NCMI. Here's the thinking. The Q2 miss is a real concern. You can't ignore it. But you have to balance that against a really compelling strategic shift and some surprisingly strong Q3 guidance. The whole thing really boils down to one word: execution. Can they actually deliver on this programmatic plan?
You know, the real question going into the next call is whether this new AI strategy can ramp up fast enough to offset the weaknesses we're seeing in their legacy business. The risk here is definitely high, no doubt about it. But if they pull it off, the potential reward could be just as high. And of course, just a final reminder that none of this is financial advice.